Welcome to NDR Signal Exchange, your go-to source for insights on the markets and economy. In under 5 minutes, we'll answer your top questions and cover key trends shaping the financial landscape. I'm Tim Hayes, Chief Global Investment Strategist, and I will be covering a client question about the market's recent decline. Has it been a normal correction, the start of a new cyclical bear market, or in the worst case, one that's also marking the start of a secular bear? Corrections are typically limited to declines of about 10%. The median of the 38 cyclical bears since 1900 has been a drop of negative 26%, lasting close to a year. There have been 4 secular bears over the period, lasting from 9 to 16 years and characterized by negative per annum returns throughout those periods. My view is that what we've been seeing so far is a sentiment-driven correction. Recession worries have been the catalyst for profit-taking in the mega caps. Looking at excessively pessimistic sentiment and oversold conditions, I think a bottom should start to form soon. The hard data has not been confirming the market worries in consumer surveys, and unless that starts to change, I think it's more likely that we're reaching the end of a correction rather than starting a new bear market. But what if we actually are entering a cyclical bear? It should start to be evident in our Bear Watch report, which include 10 indicators to provide warnings when their bearish parameters are reached. Once at least half have done so, the aggregate issues a bear market alert. After the 10 signals generated during the past 40 years, the global price index has had a median maximum drawdown of negative 20%, which was the decline during the bear market of 2022. The report currently includes a breadth indicator that warned of trouble in December and a sentiment indicator signaling a downturn from high optimism last month. But of the 6 other indicators that are eligible to generate signals, none are on the verge of doing so. Those include 4 indicators based on price action and 2 based on volatility. But if the market decline continues and the aggregate rises above 50%, warning of a cyclical bear, what would warn of a secular bear as well? Well, to address that question, we would turn to the aggregate of 20 secular bear watch indicators at warning levels. As explained in our recent special report introducing the report, the indicators warn of secular bear consistency based on their one-year changes, including indicators that tend to rise during secular bears and those that tend to be unchanged or negative. Aggregate readings exceeding 50% have been associated with all of the cyclical bears since 1965, consistent with the tendency for bear watch signals to indicate cyclical bear markets over its history since 1985. A difference is that extremely high bear watch aggregates have been reached during secular bulls and bears alike, whereas extremely high secular bear watch aggregates have been far more common during secular bears. So if the current decline is turning into a cyclical bear, then we can expect to see the bear watch aggregates start rising, potentially providing a especially decisive warning by rising above 80%. But if the secular bear watch aggregate would do so as well, the warning would also have secular bear implications. Fortunately, right now, neither aggregate is at warning levels, and that supports my view that what we've seen is a correction rather than something a lot worse. If you have more questions or want deeper analysis, feel free to submit your own for our next episode by emailing neddavisresearch@ndr.com. Thanks for watching NDR Signal Exchange. Let NDR help you see the signals.